time is the great equalizer as it relates to these investments. And so I think probably the best way to drive that home is let's talk specifically about an equity market investor in 2000. So if I was an equity market investor in 2000 and I had $100 invested in my account, everyone remembers the big dot-com bubble that happened. They saw their account shrink to about $53, $54 by the end of the year.
Oof.
A lot of investors at that point just pulled out of the market. They had enough volatility and I don't want to experience any further losses. And so they essentially locked in close to a 50% loss. Those who just stayed the course, meaning they experienced that loss, but they kept money in. Now, it took several years for them to get back to even, but if they just stayed the course and stayed in the market this year in 2026, as of about 2 weeks ago, their account would be worth $813. So, what about those that were in a variable annuity during the exact same time period? So, if they invested that money in a variable annuity, so never experienced a quote unquote loss because there was a high watermark provision, that same investor would have $592 in their account. And that's purely a factor of the higher fees that they paid for that privilege. So, we're talking a 25-year period, 20, almost 26-year period. The investor, to your point earlier, that experienced that volatility along the way, but didn't pay those higher fees, has significantly more wealth at the end than the investor that paid those higher fees to reduce that volatility and ultimately ended up having less in wealth available. So the real key message here that I want to make sure our listeners understand is time, again, time is the great equalizer. If you have 5+ years, you're typically always going to do better if you're an investor on that right side of the table, at least 80% of the time.
I think you make a good point, and I've been in business long enough. I've taken risk. Um, one of the things that I have going for me is I'm one of those people that I get kicked and kicked and kicked, and I'm going to continue to get up. And so you can continue to take those risks. I've experienced this with my own physical health, to the point that I've experienced, I mean, I've had 6 knee surgeries, 2 collapsed lungs, you name it. It doesn't matter. And I keep coming back. But the same thing holds true with business. And, Trump talks about this all the time, and you see it kind of all the time. The difference between a successful person and an unsuccessful person is the unsuccessful person gave up after 3 attempts, and the successful person continued on until his 10th attempt, and that 10th attempt paid off tenfold for every attempt prior to that. And you can't. I don't think you can ever accomplish financially in life your max potential if you don't take risks. And I've been fortunate enough to have nothing. And many people who've followed me, know my pizza story that I talk about. I'm not going to share that today, but have heard my pizza story. And I've been fortunate enough to have 10 figures in a bank account. And, I'm sorry, not 10, eight figures. I've had 8 figures in a bank account. And so you look at what it took to get there. And along the way, I've had business dealings where I've lost north of 7 figures from one reason or another. But I didn't have that by not taking a risk to get to having enough money to lose that much money. So I would rather be the person that has the ability to lose 7 figures and come back and build that to 8 figures than the person who doesn't ever take any chances along the way, and they don't necessarily ever meet their financial goals. And so it goes back to take the shot, like just take the shot. And then when you take the first shot, take the next shot. And Brian, I know you've experienced that. We've had a number of conversations around, different clients that you've had or talked to, and experiences they've had. But, you know, really, you give a really powerful example, um, with especially with the four types of investors. But the investor who stayed invested through the early 2000 drawdown or the dot-com bust, that investor ended with far more. I think it was just over 8x, 8.5x, you said, far more than the never lost money annuity investor who, I didn't lose any money and I took the nice slow route. So walk us through the lesson. Why does avoiding losses sometime lock you into a lower overall outcome?
Yeah, it seems kind of counterintuitive because you would think if I am avoiding losses, I'm going to have a bigger nest egg at the end. It all goes into fees. Look, the banks that are selling rate caps, they want to turn your losses into their gain. Operators that are advertising, we've never experienced a loss, they want to turn your loss into their gain. The big public REITs that are saying we don't have losses, they want to turn your losses into their gain. If you have at least 5, preferably 10 years before you're going to need complete liquidity, and when I say complete liquidity, just for the portion of your investment that's in real estate, this is not your entire portfolio, but for just that slice of investment that's in real estate,